I guess I'll just going to do a little bit of an intro into the stock market section. And this quote is obviously quite timely given what's going on in the stock world right now, where we've got very bubbly conditions. And I think somebody once said that there's nothing more infuriating than having other people make money, unless it's your brother-in-law. That's like the ultimate upsetting event. And why does the brother-in-laws always seem to brag the most about how much money they're making or whatever it is? But they do. It's just one of their roles in life, I guess. But okay, let's go to our opening on the stock market. And there's obviously our visual of Grant. You don't need to see me. And this is, I think, a very fair statement to make that there is this big bubble debate going on right now. These are a couple of images that you've seen, I think, in our publications that were just pretty amazing. And here recently, it came out almost simultaneously. And if you're not aware of the curse of the cover story, it's just a reality. So it's really something to see these kinds of things happening. And yet at the same time, so many pundits are telling us not to worry, that everything's just fine. And when we do hear from Grant, you'll get his take on why things like what we're seeing here are just, there's just huge warning signs. But it also, I mean, to be fair, there's a tremendous amount of momentum behind this market. And when we get to the end of the presentation, end of the webinar, we'll talk about some of the areas that are opportunities. And I do see a lot of broadening out happening here recently. So over the last month or so, it's been an interesting shift going on away from just the Magnificent Seven types of names, which is maybe the Magnificent Four. Certainly Tesla's been kicked out given its horrible performance here for the last 6 or 9 months. But it's not just tech anymore. And we are seeing even some of these really beaten up areas like the gold miners, which we were fairly fortunate on our recommendation on the junior gold miners here recently. Energy's been perking up, of course. So we did go through a similar situation last summer in June and July, where it looked like the broader market was starting to kick in. And then we went into a fairly nasty correction in late summer into the fall. A lot of that was because of what's happening in the bond market. If you don't remember, that's when Treasury yields went up to over 5% on the 10-year. But that's not happening now, although there has been a bit of a backup in yields, but nothing like that. But as you see here, we've got this shift in, this is, Jim Bianco, who's also one of my favorite savants out there. And he's pointing out that the money management industry has crossed the Rubicon because you now have over 50% of money managed, not so-called managed, it's really not managed, it's just mimics an index, mostly the S&P and the NASDAQ. And what this doesn't include is all the closet indexers out there. And also, maybe most importantly, doesn't include flows. Because if you look at inflows, which, on a net basis, that's all we have are inflows. There's outflows, but they're swamped by the amount of inflows, a lot of it from retirement accounts, 401ks. And those are like 70, 80, maybe even above 80% into passive. So from a flow standpoint, it's very dominant. And I know that's a theme that Grant would like to talk about. Do we have any sign of Grant joining us here?
Yep, it looks like he joined.
The international man of mystery is here. Hi, Grant.
The international man of mystery is on mute.
Well, you're really mysterious.
Oh, I can unmute now. I am here, Dave. Sorry, I was.
There you are.
Update the software every time I decide to jump on a call.
Well, good to have you, man. Are you joining us from Kiowa?
I am, happily. That's why I'm smiling.
Lovely Kiowa. So for people who don't know this, Grant and Adam, my youngest son, are only, 45 minutes away by car, because he's just north of Charleston, and Grant is just kind of south of Charleston. And I believe you've got a rather well-known neighbor there, Nikki Haley. I wish you could have a chat with her and get her to accept the No Labels nomination. That would do a little.
I see her power walking around the island quite often.
Oh, is that right?
Yep. Yes, well, indeed. No crowd around her. It's she's very low key here, and she's out and about in the community quite a lot.
Well, next time you see him, corral him and tell him that talk some sense into her. It would be your patriotic event of your lifetime to do that. Okay, so we were talking about, this is the Mike Green topic, Grant, talking about how much money is being mindlessly invested. And I was touching on the flow issue because there's a tendency just to focus on, this visual here, which is about 50% of money is managed, or really, I already said that it's not managed at all. It's just indexed. And what's your take on his flow analysis?
On Mike's,
Yeah, how much does he say something like 80% of all flows that go into the
it's up there.
market
Yeah,
go
it's north of
passive?
70. It's north
Yeah,
of
it's a
70.
huge percentage.
Yeah.
And that doesn't get much attention. So that's a very important point. And the idea is that markets are supposed to be price discovery mechanisms, and they're not. I mean, this is just a major problem. We had that with the Treasury market when the Fed and the other central banks were buying all those government bonds, which obviously greatly distorted the bond market. But now we're getting a complete lack of, or maybe complete lack is too strong, but a decided tendency not to have true price discovery. And it is really just kind of this massive momentum chasing game that's going on right now. And, when you look at how are the asset managers, and this is apparently both active and passive, I mean, they're really, really long this market, as my good friend Jesse Felder points out. So that's, if we look back at the past, those episodes where it was at least in the same kind of vicinity did not end well for long investors. And I think it is fortunate that not everybody's drinking the Kool-Aid. We've got, again, thanks to Jesse Felder, a visual here from the famous John Hussman, who at one time was considered to be brilliant. He stayed bearish too long, but his data is his data. I mean, it's hard to argue with. And this is another one that I think is really interesting. And this gets very little attention. I don't even know if Grant has seen this, at least recently. Ned Davis used to run this periodically. This is from my friend Jim Colquitt. And the idea is that when you look at times when investors have a very high equity allocation overall, the future returns over the next 10 years are very poor. So when we see that blue peak there to the center right, that was the late 90s, the infamous tech bubble. And then you fast forward to 10 years out, and the yellow line showed very low returns. So, and the reason that line stops is because you have to go 10 more years out. But what it tells us is with the peak that we've got now on the far right, the odds are that when we look 10 years from now, the returns are going to be very, very disappointing. And of course, that's not how people are positioned. Now, again, this has nothing to do with near-term momentum. This is really looking out on a decade's time frame. But I think it's good for us to keep this in mind. So, Grant, I'm going to stop there and just see if you want to make any comments about the market in general.
Yeah, I think we're in this fascinating kind of little air pocket here where everything's priced to perfection. Everyone's happy that it's priced to perfection. No one's really worried about it. And I saw a report from Bridgewater this morning after the FOMC meeting yesterday, and I'm going to just pull this up and quote what they said because it tells such a story in a few words about how attitudes have changed. Let me find this for you. Hold on 1 second. I did have it on my laptop, but you've stolen all my screen real estate, Dave, with your presentation. Hold on, here we go. So one of the points they made in a piece entitled "Higher for Longer: Inflation but Not Rates," which is telling enough. But this was point 4 or 5, I think. They said the FOMC wants to begin normalizing policy this year, well before it expects inflation to get back to target. And I think just that idea that we've redefined what normalizing is. They want to normalize before they inspect inflation, i.e., normal is now low, and that's very much, I think, the big sea change. And to read that from Bridgewater when they talk about normalizing, and the Fed want to normalize, they're at 5%. If you go back through 100 years of history, you'll find the average interest rate is roughly 6. So we're below the long-term average, and they are already starting to say the quiet part out loud that we need to normalize, i.e., get the market down. Now, David, I think we're going to talk about some of the stuff Mike Howell's been talking about, and I think
Yes.
this is a huge part of that. The reasons for that, and I'll wait until we get into that before we discuss it. But I think we're in this period now where that's exactly right. Normal has to be lower rates. Inflation is not, I think, going to play nice, and I think there are all sorts of nasty, sticky, embedded parts of the inflation equation that are embedded now, and the Fed, for reasons that we'll get into when we start talking about liquidity, the Fed is now at the point where they're going to have to let inflation run hotter because they're not going to have the means to combat it. And look, in an election year with what is a very political Federal Reserve, I don't think they're too worried about that. I think they are willing to inflict pain upon the citizens of the United States if it means that the Democrats get in power again. And speaking as an Englishman with no dog in the hunt, I feel like I can say that from a fairly neutral place, but it does feel overtly as if everything rests upon this election, and whatever you do in the name of getting the right guy elected will be forgiven. And so I think what Bridgewater said is right. Normal is lower. We have to realize that, but it will, I think, mean higher inflation for longer. And that's something obviously that anybody investing in the bond market needs to take very, very seriously indeed. And also when we get these cuts, historically speaking, David, I don't know if you have a chart. I think I've seen most of the charts you put up, but you know as well as I do that first cut is not necessarily when you want to be in the equity markets, although people seem to be thinking it's a wonderful thing. So,
Well, that's a great point, because there is this belief that when the Fed starts cutting rates, that's really bullish. But if you look back to the early 2000s, the Fed was cutting frantically and the market went down 50%. And the NASDAQ went down almost 80. If you go back to 2007, when they first started cutting as the mortgage market was melting down, into 2000, even in early 2009, I mean, they cut rates down to a quarter of a point. And at that point, they had been over 5. So a lot of rate cuts, and yet the market just crashed. I think
I think the point here that it's important to make is that traditionally, rate cuts have tended to come when the pain has been felt in the stock market in a lot of ways. It's certainly in the last 20 years, the rate cuts have come as a reaction to falling markets, which is where we are now with the tail wagging the dog situation. And people forget that. If they forget that it used to be that the rate cuts would come as the economy rolled over, and it was bad for stocks. So people have been reconditioned to associate cuts in rates with boom time for stock markets, because they haven't necessarily been related to the economy. They've been a reaction to weakness in markets.
Well, that's a good point. And it's a good lead into this next section about the economy, because I think in fairness to bullish investors, where Fed cutting is a rocket fuel to the bull rally is if you do get a soft landing. And so let's look at the economy and including what's happening in the labor market, because you alluded to this a moment ago. But this is the belief.
For the interruption, but we had a couple people request if Grant could turn his sound up a little bit.
Ooh, I don't know if I can. Let me see. Hold on. Let me see if I can turn my sound up a little bit. Microphone.
Well, that's better than being told to go on mute, Grant. They want to hear what you have to say.
Careful what you wish for. Once you can hear me, it might be the worst thing that's happened. Is anything changing? I've only got two. I've got two dials on my microphone, which I am desperately trying to crank up.
Sounds good to me. That sounds better to me. I really didn't notice. I'm kind of used to his accent.
I mean, I can't turn anything else up, I'm afraid. This is the same setup I record the podcast on, and it seems to come out. I'm trying to think if there's anything I can do.
Yeah, you just pull the mic as close to you as you can, and it should be fine.
Yeah, I'll just sit and talk right into it here and see if that makes any difference.
So for those that don't know Bob Farrell, he was at Merrill Lynch for years. He's one of the most famous technicians in history, market history. He's now retired, but he's got his 10 commandments, 10 cardinal rules, and a lot of them are just timeless. And this is one of the best, which is when all the experts and forecasts agree something else will happen. And that just is so true. And right now, the soft landing belief, which is what I just alluded to, that if the Fed is cutting into a soft landing, that's great. That's very bullish. But I'm going to challenge that a bit, even though that seems to be the dominant narrative right now. And if you look at business sentiment, this is a fairly recent couple of charts from Mike Wilson at Morgan Stanley. And certainly businesses don't seem to be feeling very soft landing like. This is a little anecdote. One of my creative colleagues on this call's special friend works at a very large resort in Phoenix. And they just had 5 major corporate events cancel out of the blue. And Grant's and my mutual friend, Danielle DiMartino Booth, is all over this. She's saying the hospitality industry is showing sudden weakness. So it's a very, very confused situation out there. I mean, the jobs market is constantly cited as why things are really strong, but you look at the household survey, which historically is better at picking up pivot points, inflection points in the jobs market. It's showing that it's deteriorating. And actually, there's been no net full-time jobs created over the last year. Now, obviously, jobs have been created, but there have been more lost. Most of the jobs that are being gained are part-time. And the way the non-farm payroll works, which is the official survey, it will actually, if somebody's working three jobs because they have to, three part-time jobs to pay their bills, they count that as three jobs. And so this household, I think my son Adam was talking about this before we went online, that there's no more inaccurate data point out there than the non-farm payroll, and especially when the economy is in the process of decelerating. And I do realize that's a big debate, whether that's really happening right now. But when you look at this, I mean, this is really indicating some real pain in terms of interest cost to individuals. And that could be why we now see this pretty shocking number. 10% of all credit card debt is seriously delinquent. And if I had a chart of that, it's breaking out. And I've said to many of you and written on this a lot of times that these breakouts don't just work with the stock market and commodities. They also work with macroeconomic data time and time again. So I think this seriously delinquent credit card number is going to go up quite a bit. And this is also another indication the jobs market is not as great as it appears to be. But I know Ron's got friends that he respects, and I have friends that I respect that believe it is a very red hot jobs market. So it's just another way of looking at the number of revisions that have happened. And by the way, December and January were both revised down. They were superficially, when they were reported, strong numbers, and that's no longer the case. So I would really encourage people that are trying to get a sense of where the jobs market is going to look at the trend in revisions, not the contemporaneous releases. But Grant, any comments from you? I know you talked to so many people on this very topic, and you probably have some better insights.
I don't know about better, but I mean, I've definitely got insights from people much smarter than me. Dave, I think a lot of this speaks to perhaps one of the most important overarching things that people need to understand, and that is that the policy of the monetary policy over the last 25 years has led to this bizarre situation where we used to live in a world where the stock market reflected the economy. And what we now have is the stock market being prioritized, the stock market being people's barometer as to how well things are going. And of course, with the stock market at all-time highs and nudging on those every day, no one's really looking at the breadth. They're looking at the headlines. They're looking at the fact that we are making new highs in the S&P and the Dow Jones, and everything looks great. Anyone that takes any time, and this is why the passive thing is so important to understand, anyone that takes any time to look into really any of the headline numbers will very quickly find, like you just pointed out here, Dave, underneath the reality is very, very different to the headline. But monetary policy has prioritized the stability of the stock market. They've decided that this Bernanke idea of the trickle down effect, that we get asset prices up and we get the household wealth up and it trickles down. What's actually happened is you've created a beast that's too big to fall. The stock market is now too big to fall. And so aiding and abetting that is this money going into passive, which means that people have put their money in, it's working, the stock market's going all-time highs, they're all making money, and no one's really paying attention to the real economy. And that's why I think it's so important that the Fed are so desperate to dangle this carrot of rate cuts coming. No matter what happens, they will not walk away from dangling the carrot of rate cuts, because I think they realize, looking at the real economic data, that the economy is likely to be in some serious trouble. They realize that they're going to have to cut rates, and they want to make sure that the markets are aware of that, so they know that there is support under the market if and when they have it. And the economy is not the stock market anymore. It's just completely decoupled. And as I say, Dave, you've touched on passive, and I think it's a big reason for that. Nobody's actually looking at what companies are doing. No one's really looking at what businesses are doing. They're looking at what indices are doing. And the more money goes into passive, the more it becomes self-reinforcing, that the indices go higher, the confidence rises. And meanwhile, underneath, you drill down to the Russell 2000. I don't know if you have the charts there, but we all know how poorly the Russell's doing. And the stock market is just not a barometer of corporate America anymore. It just isn't. And so how do you determine what's most important? Well, you determine it by A, where the flows are going, which is into index funds, and B, where monetary policy makers are focusing their attention. And they are, no matter what the evidence says to the contrary about liquidity and loose money conditions, they are making sure that everybody is aware that, hey, if anything bad happens, don't worry, don't panic, don't dump everything. We will come in, we will cut rates, and everything's going to be all right. And it may be, but I have a nasty feeling that for the first time in a few cycles, when the rate cuts come, they're going to be too late, and the economy is suddenly going to matter again. And a lot of these companies, and we've seen some horrendous guidance coming out of companies going forwards, if those businesses start performing poorly, if wages are so high and so sticky, they do start having to lay people off, we are going to see a very, very different world. And I just don't think that a few rate cuts are going to help matters.
So on that topic of the economy and just kind of macro conditions, I'm old enough, you're not, well, you sort of remember the 70s. You
Dave, you
remember
look
the
10
Beatles
years
anyway.
younger than me. What are you talking about?
So I do vividly remember the 70s, and that was dominated by stagflation. And my last bullet here is, are we going stag again? Which is extremely contrary to the popular narrative, which is that inflation is falling and growth is accelerating. But what if it's the opposite? What if inflation is accelerating and growth is falling? And I think there's some evidence of that. And just real quickly here, this is some economic data that came out not a month ago, but last week. Pending home sales down 4.9%. Real retail sales down 2.4. New and existing homes down 1.2. Manufacturing output down 0.9%. These are all year over year numbers. I could keep going on, but it's just, well, full-time jobs, as I said earlier, down 0.2%. Real GDI down 0.1. Now that's an important one because it looks at income versus GDP, which is historically the GDI, gross domestic income, is more accurate than GDP. So it's, I think this is not just being obstinate. I think there's some real data out there that does call into question the Goldilocks narrative. But we'll get into a little bit more of that here in a bit. And this, I know, is really up your alley here, Grant. For people that don't know this, and most of you don't, he put out an excellent piece called Commercial Break. I think it was in January, February,
Yeah.
on what's happening with commercial real estate and to the commercial banks. And what you see is the commercial banks are loaded up on commercial real estate. And where it's really prevalent is with the smaller banks, the regional banks. So if you look at the big boys like JP Morgan, Bank of America, Citi, they don't look nearly as alarming in terms of their exposure to CRE. So that is an issue because, for one thing, the regional banks tend to be the primary funding mechanism for small and mid-sized businesses, and those guys tend to be the main job creators and the main job destroyers. So I don't think this is just kind of an esoteric point. And also, when you look at the amount of exposure in terms of dollars, it's about 1.4 trillion, and you got a whole lot of these banks that actually have negative equity. So, Grant, since that's your theme, I'm going to turn it over to you on that one.
Yeah, I mean, you said it there, David. The ongoing bank run. I mean, we've seen this, and the strange. We all got a hint of this with Silicon Valley and Signature Bank, which is hard to believe it was a year ago, almost to the day, that those two went under. And at the time, I think anybody looking at that would have realized just how serious the potential fallout was, which is why Janet Yellen effectively guaranteed all deposits, not just the 250 grand minimum the FDIC ensures. And of course, we saw the future there. We saw what happened when people were quickly taking their money out of the smaller banks and bundling it all into JP Morgan and Bank of America. The bigger banks are going to get bigger. There are a number of small, medium-sized banks whose exposure on their loan book to commercial real estate is 60% plus. So those banks are really in a tricky spot. And if you pay attention to social media, you pay attention to some of the people that follow commercial real estate, you will see extraordinary transactions taking place in every major city in America, from New York to San Francisco to LA to Baltimore to St. Louis to Florida, everywhere, where commercial real estate blocks are selling, some of them 50, 60, 70, 85% below the last sale price on a per price per square foot basis. And no matter what anybody says, this matters. These kinds of losses matter a great deal. And so we're in a position now where this is slowly rippling across the country. The banks are not necessarily realizing if it's the Goldman's taking a hit, there are things they can do to mitigate that hit in terms of it causing a problem the day they take it. But slowly but surely, this stuff is building up. It's building up on the balance sheets. It's building up on the loan books of the banks, and it's building up in the assets they end up holding once they can't sell these or they call the notes in. So when you look at the commercial real estate markets, you realize just how serious the effect of rising rates has been and how quickly it's starting to unravel. Everyone's focused on the housing market, but of course, people do need to live in houses, right? People don't anymore need to work in office blocks. So this is not a problem that cutting rates is necessarily going to make go away, because you still need to get the people to come back and work. And whilst it may happen, it's not going to happen in a short time frame. And so that is a tremendous problem. And I think
our commercial real estate experts, sorry to step on your tongue there, but our commercial experts in the area, Seattle area, tell us that you just can't get financing at all for an office building.
Yeah,
new or existing, no matter what the lease structure is.
Yeah, exactly. And people think it doesn't matter because it hasn't yet, but every single one of these buildings that goes up is making anybody who's got a note coming due for financing start to look at hitting bids. And I think we'll see a wall of these sales happening. Michael Howell, again, we keep teasing Michael Howell, but let's just drop in one of his extraordinary numbers here, Dave, because I think it brings this to life. And that is this idea that there's $350 trillion of debt floating around in the system. And roughly, what is it, 60, 65, 70 trillion?
He says 70 trillion a year on average for the next 5 years. Needs to be refinanced.
Needs to be refinanced. And that ultimately, and I spoke to Michael on my podcast this last week, that ultimately is perhaps the most important thing to understand, because in reality, the Federal Reserve and interest rate policy is nothing more now than a means through which to create an environment whereby this debt can be refinanced without pain being felt. And so rates are going to have to come lower. There's a period of time where you can roll stuff and you can forego interest rates because you think rates are coming down. And this is a big reason why I think the Fed is so intent on telling people that relief is coming, so that they won't call these notes in, and they will allow people to extend. But at some point, I don't think there's enough capacity to roll all this debt over. And this, I think, is where it starts. If you go back to 2008 and you look at the chart that the FDIC puts out of bank failures, you'll see a remarkably few banks actually went under in 2008. It seemed at the time like it was a high number. But just take a look at that chart and go back to the savings and loan crisis of the late 1980s, early 1990s, where we had a situation much more similar to the one we're facing today. And look at how many banks went under back then. And I understand that standards have been tightened, et cetera, et cetera. But if we get somewhere in between 08 and 1989, 90, it's going to be a catastrophe. And I think they realize that. So I think this idea of understanding that the primary function of the Fed is to create a healthy refinancing environment. Once you look at everything through that prism, that there's $70 trillion of debt they somehow need to get rolled over, it will help shape your view of the reasons for monetary policy decisions.
Okay, so that's a good lead into this section, because one of the challenges that the Fed has will be that as they try to ease when the markets are already on fire, how do they keep doing that? And I know there are people saying, well, with all these issues that you and Dave are talking about, why is it that stocks are making new highs? And clearly the S&P and the NASDAQ are breaking out. And I've already said I'm a big fan of breakouts. I think there's some areas that we'll talk about at the end where the breakouts look a lot more investable, if you will. But when you see that we've had the fastest easing of financial conditions, it's not really a shock that the stock market has been acting so frothy. But what it's ignoring is a fairly significant backup in Treasury yields, and that really hasn't got the market's attention. That happened last summer too, and then once we got to 5%, all of a sudden the market hit the panic button. So bonds better stabilize soon. Now this also looks at liquidity. Now I believe this is actually for Michael. It is Michael Howell, who you just mentioned. And what's interesting is that the liquidity has actually kind of flatlined. It's at a high level, but it's quit going up. And of all his charts that you forwarded me, I thought this was the most interesting because you're seeing that the S&P continues to go above that liquidity line, and it's never been as extended as it is now. I mean, it got that way kind of prior to COVID, and then crashed for obvious reasons. But that, I think that's a bit of a warning flag. And then of course we've got just super bullish sentiment right now. And obviously there is still a lot of liquidity in the market. The Fed is doing QT. And one of the interesting comments Powell made yesterday is that QT is going to be turned down, not off, but turned down, which means the Fed is actually still tightening right now. And even the Fed whisperer Nick Timiraos said that perhaps the Fed might be forced into a situation where they cut too soon. Again, getting back to the 1970s, that's what happened under Arthur Burns. You'd have a bit of an improvement in inflation, and the Fed would say, "Oh, great, we need to get interest rates down," and they cut too early, and then inflation took off again. And I guess what I was thinking about listening to Powell yesterday and reading some of the comments is what would, if we hadn't had these hot inflation numbers the last couple of months, and for anybody on this webinar that doesn't know that, it's been a series of really negative surprises, too hot inflation. What if it had been the other way around? If the inflation had been low, what would they have done? I mean, would they have, cut it just regardless of how frothy the market is? And what do you think?
Yeah.
Do you think they worry at all about creating a bubble? Is really what I'm saying. Do you think they haven't paid attention to the history of the prior bubbles that they've let inflate to gargantuan proportions?
Dave, Marco Papic, who's at Clock Tower Group now, fantastic geopolitical analyst, and great fun to go out for dinner with. He talks about a world of constraints and preferences, and it's one of these frameworks that once you hear it and you hear someone describe it, it changes the way you think about how to handicap the world. And what Marco says is everybody has preferences, things they want, things they would like to do, outcomes they desire, but they also have constraints, and we essentially live in a world of preferences that are bound by constraints. And I think this is exactly where the Fed now finds themselves. They have preferences. There are things they want. There are prints they need. There are courses of action that they want to take, and they have very, very clear preferences. And we are at the point of bumping up against the constraints that are going to actually force them to either take action, Dave, to either do things that go against their preferences in order to keep the lid on this, or as I said earlier, they're going to make decisions that are based around a short-term outcome, believing completely that they can tidy it up afterwards. And we've seen plenty of history of that. We've seen plenty of confidence on the part of the Fed. We saw Janet Yellen last week say she regretted using the word transitory. What she didn't say was she regretted using it over and over and over and over again in every single conversation she had, and making sure every other Fed governor used the same word. If you go think back to that transitory period, it was rammed down our throats every day. So I think they're running up against what they want to do and being forced to consider what they have to do, and they're in a position of having to make that decision. Do we do what we have to do, or do we allow inflation to run hot in the full and strong confidence that we can tidy it up afterwards? And everything I've seen from them in the last 20 years tells me that the hubris level is high enough that they will believe that we can let it run hot for a bit and then we can tidy up afterwards. And I suspect strongly that that will be a catastrophic mistake.
Well, to your point, I've got what I think is one of the more fascinating charts coming up here in the section on inflation. So first of all, this, I do hear, again, this transitory idea about inflation, and yet when you see things like this, and it very much is reminiscent of the 1970s. This chart doesn't go back that far, but strikes, of course, were very prevalent back then. So you have this, chain reaction of, much more militant labor. They're getting higher wages. It's not a theory; it's happening, and then it does lead to more embedded inflation. And I've got friends like you do that believe that we're going to see a lot of layoffs coming, which I actually agree with, but let's say we get to 5% unemployment, you still have 95% of the people working, and a lot of those folks have got these pay increases that are built in, for the next few years, particularly any kind of unionized situation. But that also set the tone for the rest of the private sector and their wage negotiations. So I think this is going to be a real challenge in trying to get to the 2% target. Like you, I think they're probably going to get it down somewhere in the threes and call it good enough. or at least try to fudge it. And the other thing is that I'm sure you've seen this. I think most people aren't aware. Over the last 2 years, about 70 to 75% of the inflation improvement has come because of the collapse in the price of energy, oil and natural gas. So 2 years ago, we had the invasion of Ukraine. Oil went to $120 a barrel. Natural gas in the US went to 10. It went to, I don't know, 100 in Europe. And then prices, of course, have come way down. And back in December, we put out our table pounder on oil when it was in the 60s, and it's now in the 80s. But that's going to be a problem. If oil is in rallying, and I know the powers that be will try to do everything they can to keep oil down between now and the election, whether they can be successful, I don't know. But it's going to be very hard to get that same kind of deflationary or disinflationary impact from energy that you've had over the last 2 years. And on top of that, you're going to be dropping off some of these very favorable inflation readings that happened a year ago. So I'm seeing more and more data and persuasive arguments that, it could be 3.5% to 4% here for a while. But this is the one I don't even know if you'd seen this one. This actually came from the NBER, which, as you know, Grant, is the official arbiter of whether we're in recessions or expansions. And so they did a fascinating thing.
Whether we have been in recession, don't forget.
Right. Yeah, it's always very, you're right. That's, like a year later, they finally make that call.
Right.
But what's fascinating about this, and I really hadn't thought about this, is that you at least for the majority of consumers, you need to look at the impact of these much higher interest rates. I showed some of those charts. I mean, you probably know this. The average interest rate now on credit card debt is 22.75%. There's over $1 trillion of credit card debt now. Not all of that revolves. I realize that, but a big chunk of it does. So these higher interest rates are a real cost of living increase, not for the people necessarily on this webinar. For us, it might be disinflationary because we're making more income from our, say our cash equivalents. But for the typical, most of America, I think it is a legitimate way to look at the CPI. Have you seen this before?
I haven't. No, I'm just looking at it now. It's the first time I've seen it. I mean,
I think it's fascinating.
Seen shadow stats, and I know that they go back to I think the late 80s, early 90s, and use that measurement, and CPI is always higher, but I haven't seen this one before.
Well, the housing is part of the adjustment, but the big delta is because of including the change in interest rates, and it's I think that's why people is disenchanted with the economy. You would think that there'd be a lot more optimism, but I think this explains why. It's just not very. I mean, we know that the grocery store prices have been sticky. And now, when you look at, like, for people buying a new car with it used to be almost 0% financing, and now it's more like 8-9% for a new car. And of course, you have the insurance rates, which is not included in this. But anyway, I think that it's important to realize that the CPI number that we're looking at is I know you have a lot of folks that are in your universe that have been very suspicious of the official CPI, and I think this just really drives it home pretty graphically. So probably don't need this, but I think it gets to the point that the Fed's going to have a really tough sales job to do to convince the world, the financial markets, that they really have inflation under control. But they'll do their best.
Can I add a couple of things to that?
Sure.
Firstly,
Sure.
about the wages. I think the wages is such an important thing for people to understand. Wages don't go down again. You don't cut people's wages when inflation subsides, and so wages are so sticky. And everyone's been talking for many, many years that, Japan has been this leading light. And if we all look at Japan, we'll have a good handle on what's going to happen in future, both for monetary policy and deflation and, everything you want. Japan has been the vanguard of all of that. I mean, I think that's a far too simplistic a comparison, but one place that I think people aren't really paying attention are wages in Japan. And the way it works over there, they have basically an annual negotiation for wages, and the companies and the labor unions meet and they decide what the wage increases are going to be, which is a very Japanese way of doing it. Everyone gets together and we all come to a consensus. They've just concluded the latest round of wage negotiations, and Japanese workers have just been awarded the highest increase in 30 years. And that's
I actually had that chart in here. I took it out just because I was running out of space,
okay.
But it's a great point.
But I think it's really important, Dave, because this is a country that has struggled mightily, as we all know, to create any kind of inflation, and they've now got the stickiest inflation of all at a 30-year high. And so I think that's really important, because what we've seen in the US are a lot of big companies, Walmart's, Amazon's, giving out pretty high wage increases. And of course, the problem with that is that these companies employ a lot of people. So everybody is friends with or are neighbors with a Walmart employee or an Amazon employee. So everyone is hearing about, hey, we got decent wage. So that feeds through. And to your point, Dave, about why people are grumpy, when people are grumpy and they hear that their buddy who works for Costco just got a really decent wage hike, it foments that. And I think that's why there's so many people looking at Google searching strike. It's why we're starting to see labor agitators. We're certainly seeing them in the UK. We're starting to see some high profile trade union leaders getting the kind of exposure we last saw in the 1970s when there were a lot of firebrand trade union leaders in the UK. And this pattern's repeating over again. So I think watching wages is an incredibly important thing to do.
Great point. And some of the people on this webinar have heard me say this before, that the average UPS driver now makes $170,000 a year, including benefits.
Right. Right.
So that does, we're very, especially with all the digital connectivity, that you don't suppress that information. It gets out there, and it gets back to the opening slide from Charlie Munger about envy. And so let's talk a little bit more about these Fed rate cuts. And it is amazing that earlier in the year, there was expectations of almost 7 rate cuts for this year. And I know you and I were both very skeptical of that. And now that's come down drastically, which again, you would think that what if it had gone the other way, where instead of expecting fewer rate cuts, we're expecting more rate cuts? What would the stock market be doing? So it's pretty staggering, really, when you think about what a reality, wake up to reality this has been, and yet it's done nothing to dissuade or calm down the animal spirits. And then this is my famous 4F, federal fiscal funding fiasco. And it was David Stockman, but also not Adam Taggart, but he was on Adam Taggart when he was talking about that. But it was Michael Hartnett from B of A saying the same statistic, that the U.S. government deficit is increasing $1 trillion every 100 days. And I was like, what? That can't be true. And I actually went back to our team at GovCal and asked them, and they said, yeah, that's pretty close to what it's doing right now. But even if it's $2.5 trillion, which if you look at the latest Biden budget, so the fiscal 2025, if you haven't seen this, they're projecting 7.3 trillion in spending and about 5 billion in revenue. So about a $2.3 billion deficit that they're admitting to. That's their projection. It's likely to be worse than that, and particularly if we get a recession. So when you look at the amount of bond issuance that's occurring, and to the point of Michael Howe, when it comes to the federal government this year alone, next 12 months, there has to be about 8 trillion rolled over. So bonds that mature, of course, at much higher interest rates, and then 2 to 2.5 to 3 trillion of new debt bonds to finance the deficit. So it really is a true financial fiasco, in my view. And I know you don't exactly have warm feelings about this either.
No, look, it's so preposterous, Dave, that we sit here and throw these numbers out like they're nothing, right? I mean, imagine talking 10 years ago about the deficit increasing $1 trillion, $3.5 trillion a year. It just,
nobody would have believed this. They would have thought they'd have given us one of those sport coats of buttons in the back.
Yeah, right. But we're here, right? And we've got to this point, and nothing seems to matter. But I think if people listening just take one thing away from this, it's very easy to talk about the problems out there, and it's very easy to think, well, we'll figure it out. These numbers are so big, there will be a way around this. I think the important thing for people to understand is to be aware of the problems and be aware of what could potentially go wrong, because all the time markets are going up, none of this stuff matters. But at some point it's going to matter. That number, that 100 trillion every 100 days, what if it's 100 trillion over 50 days? Will that matter? I would suspect it might. Somewhere out there is a Rubicon that these numbers are going to begin to kind of topple over, and being aware of where the pressure points are, of where the kind of numbers that are going to matter are, I think are the key to making sure that you're not one of those guys who says, yeah, I understand all this, but I'm going to ride this and I'm just going to get off like Bugs Bunny does to jump out the elevator right before it hits the ground. And I think we're in that. Despite what you think, the elevator is falling, and everybody's just thinking, I can step out before we hit to the ground. And there are so many major difficulties that we are expecting monetary policymakers to navigate for us, because they have done. successfully for the most part for 25, 30, 40 years. We go back to Greenspan. I just don't think it's going to work out as easily this time.
Well, to your point, I've heard our mutual friend, but especially your friend Mike Green, talk about that the bond markets, unlike equity markets, do have an embedded, uh, like reckoning, embedded, basically, reality check. Like he has a different term for it, but it's maturities, and as these maturities happen, and this is what Michael Howell is really harping on, that's when you really get, the game is up. That's when you have that Wile E. Coyote moment of off the cliff. And as you mentioned earlier, Michael Howell is looking at 70 trillion, which is really a staggering number of debt that needs to be refinanced. A lot of that, of course, is in the U.S., but not all by any means. And then you've already got this S&P 500 companies, and what their interest rate increases is looking like today is drastic, and it's going to go higher. And of course, that's for the blue chip companies. When you look at as you were mentioning earlier, the Russell 2000, it's even more dire. But the stock market couldn't care less at this point. But as those refinancings have to happen, and it's not just a down the road thing, it's very much of a 2024 event. I do think that we probably are going to see some of this complacency go away and go away fairly quickly at some point. Don't ask me when that point is, but I do want to say that there are some optimistic things to focus on. And you mentioned Japan a lot, and that's been one of my favorite markets, as our newsletter readers know. Been touting that for quite a while. For U.S. investors, of course, the weakness in the yen has been detracting from returns. Despite that, it still had a very good return, particularly this year. And you look at how uncommitted investors are to the Japanese market. I mean, it's a very high level of apathy. And even for their domestic investors, they only have about 13% of their portfolio in equities. They've got 50% in cash. In the U.S., it's basically the opposite. 50% in equities and somewhere around 15% dollars relative to the market cap. They've got 7 trillion in U.S. dollar equivalent in cash in Japan, and their total market cap is 6 trillion. So if there's going to be, and of course they don't have 5% interest rates on their short-term cash, they've still got basically zero. So you could see this market, which has been a dog for 30 plus years, continue to run. And this is a series of breakouts. In fact, speaking of running, I was out running with my dogs a couple of years ago, listening to your podcast, I think with Stephanie Pomboy, when you said, hey, I actually think the Japanese market's going to go up. And you've been correctly bearish on it for as long as I've known you. Yeah. And then I looked at this chart and some of the incredibly cheap valuations over there and looked at it. So my people know, Grant, that I'm always harping on these breakouts. And 3 years is kind of our minimum to be a real strong signal. And you can see there's just been a series of these. And the longer the trading range has been in place, the more meaningful the breakouts are in my way of looking at the world. So, obviously the Japanese market's had a big run here lately. It's extended. It'll probably pull back, but I think that's a place where you could be putting capital, dollar cost averaging into weakness on a regular basis. Sorry,
Dave, I agree with that wholeheartedly. I think it is extended. I think it's attracted. Once it finally broke that 1989 high, and I was working in Tokyo when it broke that high, so I felt the last 40 odd years, believe me. But once it broke that, it attracted a lot of headlines, a lot of coverage, and I think there's been an awful lot of money come into Japan. If you go back one chart, you can see just how sharply it's gone through that 40,000 level. So there is definitely some short-term froth in Japan. But if you actually take a look at what's happened in Japan over this period, the Japanese companies have been forced to do the two things that they never ever did before, and that is improve corporate governance, improve the way they take care of shareholders, and get their balance sheets in good shape. So again, Japan, for me, is if you're a stock picker, if you're someone who's prepared to do the work and look at companies and not just buy the ETF, which has become the kind of favorite thing for a lot of people to do, you can go to Japan, excuse me, and find world-class companies. A lot of them were trading at 70% of book value. They're not trading there anymore. A lot of that has been taken out in that kind of right-hand half of that chart. But there are still extraordinary companies that are in tremendous shape, trading at incredibly sensible valuations. It just takes a bit of work. And I think Japan is one of those places that it's been in the doldrums for so long that nobody's really familiar with it. And so there's a period of time to get familiar with Japan. I mean, people forget what a powerhouse Japan was back in the late 80s. But if you've had any kind of career for the last 25 years, you didn't even need to care about Japan. It didn't really matter, even in Asia, let alone the world. So there's a period of reacquaintance with Japan. And in that period, there are all kinds of opportunities for people who are either familiar with it or have done the work, who are prepared to accelerate the work. I think, this is the third biggest economy in the world. World-class companies, much, much better management. They're very serious about corporate governance now, and that was a big turnoff for a lot of investors. So to me, Japan is one of the real bright spots, even if I think it is a little bit stretched in the short term.
Well, to your point, this is actually a chart of the yields over there. So this isn't bond prices. This is the 10-year JGB yield. So again, you can see these breakouts from super low levels, and it's still, even with the big increase that's happened, it's still, what, 80 basis points? So 0.8% versus 4.3 on a US 10-year treasury right now. So when, theoretically, stocks and bonds are in some degree of competition, it kind of relates to the equity risk premium. And so this means that, when you've got stocks selling at 15 times earnings, which is basically a 6 or 7% earnings yield, way, way higher than the yield on the treasury bond over there. So that's also another reason why this could keep on going. I think those yields are going higher, but I mean, even if they get to 2%, that's still not going to be a lot of competition for their equities over there. But also I wanted to end this on a high note on mid caps in the US, because some of you know that I've upgraded mid caps because they are clearly breaking out. And what's nice about mid caps is they're also trading at mid-teens multiples, about 15 and change. Now that does exclude money losers, which is also done for the S&P, but it's a bigger positive for the mid cap because there's more money losers in the mid cap index than there are on the S&P. So we've run a little longer than we normally would on our actual formal presentation. I apologize for that, but I wanted you to hear a lot from Grant. And so now we'll open up to you guys, and Adam, take it over, please.
Yeah, feel free to raise your hand with any questions. We did get a note from one of the listeners that said, on the note of real estate, do you have a take on the outlook for the residential market?
Well, maybe I should answer that because it's something I've been looking at a lot lately. And I will say I'm just absolutely amazed at how well the home building stocks have done. I've admitted that before, but affordability is awful as it is. And we all, I think, kind of know the reasons. But I think what is not really well known is how many multifamily units have been completed, because you can make the case that there's been underbuilding of single family residences. But conversely, multifamily has just gone ballistic in terms of new construction. And I do believe that's going to be competitive supply. Now, obviously, if you have a choice between an apartment and a home, you're going to choose a home if you can afford it. But I just said a lot of people can't afford to buy a home at these prices and at these interest rates. So, and will some of these apartments or a lot of these apartments get converted to condos? That's pretty easy. What's not easy is converting office buildings to condos. That's a much more difficult prospect. So I do think supply is coming. I think supply is coming from Airbnb units that have been taken off the market, and those things aren't cash flowing now. So I still think at some point you're going to have a shakeout in residential real estate, but I've been very wrong about when that was going to happen. I'm just continue to be astounded by how strong that market is. Ron, I don't know if you want to add anything to that.
Yeah, the only thing I would add, I think that point about Airbnb places coming on is a really important one, and it's not necessarily understood. If you the two places that I think are the best illustration, if you go to Palm Springs, which I know is near and dear to your heart, Dave, and you go to kind of South Florida, and you take a look on Zillow at the homes for sale, you will see an extraordinary number of homes, and these are two hotbeds for Airbnb. So I just take a look at those maps. It's actually worth taking 2 minutes to do it. It'll astound you.
And Austin, Texas is very weak, which have been one of the hotter markets. And I can personally attest to Coeur d'Alene, Idaho, which was in fuego a couple of years ago. It's a very soggy market right now. So it's kind of what did Churchill say about Russia, Soviet Union, a mystery inside of a conundrum wrapped in an enigma.
Inside an enigma, yeah, something like that.
Something like
that.
that.
Remember that quote, Dave? Don't you just get the
Jeff Harbaugh, go ahead.
Yeah. Good morning, gentlemen, or whatever.
Hi, Jeff.
It is. Can you distinguish in real estate between the office buildings and the rest of the sector comparatively in terms of the problems? I am also curious what part of the real estate problem or the real estate loans have been securitized, because as I understand that, those won't affect the banks.
Well, the only thing I would say is that was what people said about subprime mortgages back in 2007, that they'd securitized them and they'd offloaded them, which was true. But what people underestimated, including Alan Greenspan, is that their investment departments were busy buying up all that type of paper. So maybe if they were at B of A, it wasn't B of A paper, but it was, Bank of America paper that, or I'm sorry, maybe it was Citigroup paper that they were buying up that was just as dodgy as what their bank had been creating. So I think that toxic paper is still out there. Now, maybe you could say there's more of it that's held by private credit than there is in the actual banking system. But as we've already seen, these small and mid-sized banks have got a lot of exposure. So I would suspect that this time around, it's not going to be the big ones that get into hot water. But Grant probably knows more about that. He
Well,
studies that. I mean, again, he wrote a great piece on that.
Yeah, and I'm very happy if anybody wants to read it. Who hasn't, I'm very happy to share that with anyone that Dave, people email you. I'm very happy for you to send it out to anybody who wants to read it. But I think the two things. One is the amount of refinancing that needs to happen in the next couple of years, and the charts in that piece. I forget the actual numbers off the top of my head, but it's a lot. And for that to be happening at a point where we're seeing so many of the deals like the Smith Tower you mentioned there, Dave, happening, is going to greatly lessen the inclination of people to take risks in terms of rolling stuff over. So I think we're at the point now where the rollovers come due, the market price action is going to be a real headwind for people to get that stuff rolled over. And again, I think, Dave, your point is so on point about the subprime being contained. I mean, everybody wants to think this is contained. And I mean, nobody had more information than Ben Bernanke ahead of that 2008 debacle. Nobody. And they honestly believed, coming back to this point of hubris, that this would be contained. And if it isn't, we've got this. Don't worry, we can handle this. And I think the CRE market is far more problematic, because we're not talking about first homeowner grants here in the $5,000, $6,000, $7,000 range. We're talking about $100 million deals that, when they go wrong, you get 50, 60, 70 million dollars written off. And so I think it has the potential to be a real big problem, because it just feeds into that bank run that we saw. And look, it may be a great thing for JP Morgan and Bank of America if a lot of these mid-sized banks go and they all get swallowed up. We get more centralization, more concentration. It's great for those guys. I don't necessarily think it ultimately works out very well for the consumer.
And I guess to reinforce what you just said, if you look at the financing structure of commercial real estate, it's a lot more variable. I mean, as we know, one of the huge advantages the U.S. housing market has, it's fixed rate debt for the most part, and much more so than it was, say, 15 years ago. And then also it tends to be shorter maturity. So these commercial real estate loans tend to come due on a shorter time frame, 4 or 5 years, not 30 years. And I think you're going to have the same kind of bank attitude towards refinancing as to new financing, which is they just don't want to do it. So yes, I think you're exactly right. I think we're in a phase here where there's going to be just a really painful wake-up call. And I personally don't believe the banking crisis is over. I think we're going to see wake up one day and we're going to find out a bunch more of these kind of mid-sized banks are in trouble. I mean, there was New York Community Bank, a month and a half ago?
Yeah.
I believe a Japanese bank got nailed in that same commercial real estate net as well.
Yep, and a big German banker too. I forget the name of a big German bank had the same thing over U.S. property exposure.
And one thing to remember is this bank term funding program started about a year ago. I think a little over a year ago now. And that did buy time for these guys, but that clock is up. So I think we're at a point where we're going to see some of the bad stuff really coming to light.
Thank you.
Looks like we got a question from Jay Fine. It looks like you're on mute.
Yes, thank you. You've mentioned what I believe are competing influences on interest rates, stickier inflation on one side, and then the need for the Fed to accommodate refinancing on the other. Is there some way to reason through what wins out on the direction of interest rates over the next little while?
I think for me, Jay, I think $350 trillion wins out ultimately. You know, I think they are far more incentivized to make sure that that kind of money can be rolled over as painlessly as possible. If the other side of that is what they believe to be slightly hot inflation for a little while, and we've seen how good their inflation forecasting is, and of course, given that they've had under 2% inflation for such a long time, it gives them the leeway to talk about average inflation target, so they can come up with an excuse for why inflation can run hot. We can start talking about, you know, well, if inflation's 4% for a couple of years, it brings us back to this over the last 10 years. You know, there are plenty of levers they can pull on that side of things to jawbone and to talk around what they do. There aren't really any levers if $70 trillion doesn't get rolled over. So for me, it's a very clear choice for them. We have to make sure that we don't have a $70 trillion default cycle. So I don't think there's even a decision for them, to be honest with you.
So Grant, to partly deal with that rollover risk, I saw a few pages in a recent Luke Groman, and I know you're a big fan of Luke's as I am, and he was citing a recent release or white paper from the ISDA, which is the derivative regulatory entity, and talking about how there's a movement to allow banks to hold U.S. government bonds with no reserve requirement. Yeah. And of course, they've done that in the past, right? They did that after COVID. What was it? The SLR was suspended. And so where I'm going with this is, you know, can this be a stealth way that they help with this rollover challenge by giving the banks basically a free pass and telling them that U.S. Treasuries are risk-free, which is actually very ironic since it was the U.S. Treasury holdings that brought down the three banks a year ago. It wasn't dodgy loans. It was the safest securities. But
well, I mean, Dave,
what do you think? Could that be one of their ploys?
Well, no, the risk in Treasuries is that you have to mark them to market, right? That's the risk. Ultimately, they're talking about there being no credit risk, which arguably there isn't. I mean, the US will pay you back your Treasury bills. What it'll buy you when you get it back, nobody knows. But the risk is marking to market, and that's, you know, we haven't even got into the private credit world yet. Perhaps we will, or perhaps that's a whole webinar for another day. But you know, I think they will do everything they can to mitigate this potential default cycle, because it's just so potentially so big that they will pull whatever levers they think in the short term will keep the whole thing together. So it wouldn't surprise me to see them do that in the slightest. It wouldn't surprise me to see a FASB 157 type replay that we saw right before 2008, where they, you know, suspend mark-to-market rules, where they suspend the held to maturity and securities for sale rules for bank treasury holdings. All these things are on the table, and I think underestimating the lengths that people in a position of responsibility will go to keep this thing together, given what we've seen in the last 20 years, is a huge mistake.
Very well said. I agree.
Thank you.
They're pretty clever. I would not underestimate their ability to kick the can again. But at some point, I mean, these numbers are getting so large, and I think people are kind of waking up to it. That's why I believe the bond market, particularly the long end of the bond market, is going to be what really calls their bluff. Anybody else?
Well, I've got one more related to that, if I could. Do you think the Fed will stop paying interest on reserves at some point?
Well, I have seen that as one of the solutions, is that they would require banks to have, say, 10% in reserves that are non-interest bearing. And that would be obviously viewed very negatively by bank investors. I think that would be viewed negatively in terms of inflation expectations. But it could happen. I wouldn't, like I said, I think that, you know, one of the mistakes that those of us who've said this whole thing is a house of cards have constantly underestimated is the creativity of policymakers, you know, both at the Fed and the Treasury. So I wouldn't put that beyond the realm of possibility by any means. In fact, I'd say it's a probability. But what do you think, Grant?
Well, I would say this, with all of this stuff we're talking about here, they are going to be responding. Everything will be reactive, not proactive. And so we have to think about if there is a situation that occurs whereby stopping paying interest on excess reserves alleviates that situation, they will do it. There is no way they are going to stand firm in the face of a problem where there is a solution at their fingertips. So again, it comes back to this idea that the whole issue now is, how do we keep this thing together? How do we create a refinancing environment? How do we maintain stability? How do we avoid a market meltdown? Those are their goals now. It's not 2% inflation and stable employment. Those are simply not their goals anymore, no matter what they say. And so in the pursuit of maintaining that stability, in the pursuit of creating that secure refinancing environment, nothing is off the table. So if you can conceive of a situation that would warrant ending payment of interest on excess reserves, they'll do it. I have no doubt in my mind at all about that, unfortunately.
But I do think it's fair to say that all these stealth tactics are, in the end, inflationary. But if that was really true, you would think that gold would be breaking out to a new all-time high. Well, actually it is.
Yeah.
So I think gold is telling you that there is something going on here, because really it shouldn't be acting as well as it is when you've got, what are, allegedly still fairly high real interest rates. And, the huge opportunity.
And declining holdings in the ETFs, David, significantly.
Exactly.
Holdings in the
So
ETFs.
if you're not aware of what he's talking about, it's the polar opposite, the inverse of what we saw with the inflows into the U.S. equity funds, and of course, particularly tech, that you're actually seeing the GLD, the biggest gold ETF, experience outflows. Now, where the gold is being accumulated is with foreign central banks, like the Bank of Japan, and specifically the People's Bank of China, and I forget what the central bank is in India, but these foreign central banks are all big buyers of gold right now, because they really, what you're seeing is a massive transfer, or it's a gradual shift. It's not an overnight, but it's pretty dramatic, away from U.S. Treasuries as the reserve asset of choice for these foreign central banks, and toward gold. And so they're indicating, even with 4% yields on treasuries, that they don't trust the U.S. government to pay back in real terms. Now, as Grant said, they can always pay back in nominal terms by printing more dollars, but are those dollars going to be worth what you paid for them, even including the interest? And a lot of central banks are saying they're not. So, and of course, the incredible opportunity, I think Grant and I would both say, we never dreamed that you would see gold, pushing 2,200 an ounce, and see the gold mining stocks so detested. But that's starting to change. And as many of you know, I think that's one of the big opportunities, particularly with GDXJ right now. That was a little bit of a departure. Grant, do you have any thoughts about the gold miners? This is an area that I know you've liked in the
I couldn't
past.
have put it better myself. I couldn't have put it better. The only thing I would say is, when you say it's hard to believe they could be so unloved, I think if you've been investing in them for any period of time, it's really easy to believe they could be so unloved, no matter what. I mean, they've been beaten down, and the market cap of the entire sector is so tiny now. To me, there are periods where I think investing in miners, particularly junior miners, is a really good risk reward proposition, and it hasn't happened often. In fairness, I've not come out often and said now is a decent time. I did that at the end of 2015 when I put a presentation called Nobody Cares together, and I did that again in January. I was speaking in Vancouver, and I gave a presentation called Rise and Shine, which talked about this, and I tried to show that the gold mining shares are so unloved at a time when there are so many positive tailwinds for the metal itself, that at some point, as unloved as they are, if the metal keeps proving the people wrong, focus is going to shift to the miners. And we've seen that. We've seen the likes of Stan Druckenmiller take positions in a couple of gold mining shares, which always is good for headlines. But friends of mine who run small cap mining funds have said that suddenly they're getting incoming phone calls as opposed to having to make 1,000 outgoing calls a day and mostly get hung up on. So things are definitely changing, but investing mining stocks, particularly junior miners, is not a throw a load of money at the wall and hope it works. It's a place where you need to be pretty selective. The GDXJ does work pretty well, but a little time spent on identifying good companies can yield extraordinary results, I think, in times like these.
I want to give you another pat on the back because it was almost 4 years ago to the day that you were staying with us right where I'm sitting. And it was during the pandemic panic and the GDXJ was getting absolutely annihilated. And you were very bullish on it at that point. It was trading, I think, in the low 20s. And later that year, it had almost tripled. And I think a lot of investors forget when these things get a tailwind, they can really go. That small market cap aspect can really work in your favor when you get money flowing into them.
Yeah, absolutely right.
So thank you, Grant. That was one of the best tips I'd ever gotten.
Well,
anybody else with questions?
With you rent free, so that was okay. That was a good trade.
We had a question in the chat. Won't lower interest rates drive residential housing prices up?
Probably fair to say, though prices are so high right now, and also it gets to this point of what's going to happen at the long end of the bond market, and I think that's where you're going to see, using that term again, sticky apply. Hard to get those longer term interest rates down, even if the Fed starts to cut. Because for one thing, I think if the Fed's cutting when you've got this somewhat elevated level of inflation still, maybe more than somewhat, that does have inflationary implications, and those inflationary implications and influences do tend to put upward pressure on longer term rates. Maybe if they just kind of stay where they are here for a while, even if the Fed does cut. But again, I think Fed cut expectations are premature. I think it's going to take something pretty bad happening. Let's say really a meltdown in commercial real estate that starts to trigger a chain reaction, a daisy chain of banking failures. Then I think you could see the Fed forced into an actual cutting cycle. And yeah, that would probably somewhat help residential real estate. I think it's going to help other things a lot more. These things that tend to be, true inflation hedges, which have really been underperforming for most of the last 2 years. I think that's where the real value is currently.
Yeah, I couldn't agree more, Dave. I think I echo every word of that. I think that long end of the bond market is going to make it not as straightforward as one might think, where you join that one dot of cutting rates to the next dot, which is higher house prices. I don't necessarily think the transmission mechanism is going to be the same this time around.
Another question from the chat. Why has the yen versus the dollar not gotten stronger this week?
Oh, do you know what? I find this absolutely fascinating. I really do, because I completely agree. It baffles me. But I think that the yen, I talked about the yen when it was at like 154, I think it was, and this was in advance of the BOJ actually removing that negative interest rate policy and saying what an asymmetric bet the yen was here. And it wasn't that it's going to go straight to 100, but from 154, from 151 or so, to conceive of a world where it goes to 160, 170 was very tough. I would have thought it would have gotten stronger this week, but I've been just amazed by how little real coverage what the Bank of Japan have done this week has gotten. And I put a lot of that down to the fact that the numbers are so small. Going from minus 10 basis points to 0 or plus 10 basis points just doesn't really move the needle for a lot of people. It got so little coverage. But what that means for capital flows potentially, and I think the shift here from the Bank of Japan is their language has now changed to unless we can find a reason not to, we are going to raise rates. And that is a sea change from where they've been for 20 years, which is rates aren't going anywhere while any of us are alive. And with Japan being the biggest exporter of capital in the world, this is a massive change. And just because the yen hasn't moved yet, I think a lot of people are sitting there going, wow, okay, maybe this isn't as big a deal as some people are saying it is. I just don't think that's the case. Sometimes things move slowly. I think if the yen starts to move, given how big the carry trade is, I think the yen could see a violent move upwards against the dollar. I really do. And I think the chance of it going, through 160 is very, very low indeed. So to me, I echo your question about why hasn't it gotten stronger this week? But I suspect this is one of those little air pockets where something happens and it doesn't react. Everyone goes, oh, maybe this isn't a big deal. And then it reacts. I'd be amazed if the yen hit 156 before it hits 135, to be honest with you.
And as I think all family members and clients know in this webinar, I totally agree with that. I'm very bullish on the yen. I think it's one of the most undervalued assets on the planet.
Well, I think that looks like that's about it.
Thank you, everybody, and thank you especially, Grant, for your time. Knowing how busy you are. You probably log more frequent flyer miles per year than a Singapore Airlines captain. So really appreciate you actually being on the ground here and spending your time with us. So, beaucoup thanks.